So, how do we identify trend in real time? Right. So take a look. Instead of higher highs, higher lows, lower highs, lower lows, moving averages, all that stuff. Okay. Notice here. Now we're going to look at real charts after this. So prices are trading sideways. All of a sudden there was a drop in price, right? This white candle here. So while prices are moving sideways here, there's no reason to guess whether you're going to get a breakout to the upside or breakout to the downside. Just understand that once prices drop as they do here, okay, that tells us objectively, without thinking, we are in a downtrend. There's no reason to buy. Okay? All right. No reason to buy. We're in a downtrend. Down here, you get another base. Again, you get another decline out of this area. Okay? That tells us whatever market we're in, we are still at price levels where willing supply exceeds willing demand, which means in real time, there's no reason to buy because we are real time in a downtrend. Right? Okay. Down at the bottom, we get another series of basing, but at this time, instead of declining, we get our first rally, right? Okay. Once you get this rally, think about it. That tells you objectively, it tells you objectively that you finally reached a price level where willing demand exceeds willing supply. Okay? That's the only thing that can cause a rally in price here. Okay? So therefore, we want to buy that first pullback. That's, again, what we focus on here in the sessions. All right? But by the time you get higher highs and higher lows, you're so late to the party, it's not even, I don't know how you'd ever make money doing that. Okay? All right. All right, so let's keep going here. Let me go to the next page just a second. All right, I'm just kind of reading back here, making sure I don't miss too much. Just reading back here. Yeah, so great question there. Who wrote that question? Treasure Beach, yeah. Boy, two great things there, a treasure and a beach. Perfect. Anyway, just your question, yeah, a little off topic, but I'll hit it because it's very important. How prices leave a level tells you almost exactly how they're going to come back to a level. So if you have a level that's created with kind of this grinding pattern to the upside, kind of stair-step pattern to the upside, be assured you're almost always going to get that same stair-step pattern down. Remember, every level, we don't talk about this enough, but every level, is created because of another level's existence. But you'll see, Treasure Beach, that every time you get a strong rally, strong move away from a level, it's almost always a strong crash right back into that level. Small time frames, bigger time frames, same thing. Okay. All right. So take a look. So prices are trading sideways here. This is a real chart of what we looked at. Drop in price. In real time, you're in a downtrend. We're at price levels where supply exceeds demand. No reason to buy. You can certainly short the rally here. This is our setup with selling at supply, right? Same thing here. Prices are trading sideways. Drop in price. Okay. Again, in real time, we're still at price levels where supply exceeds demand. Real-time downtrend. Same thing here at this level. We can certainly short this rally back to this level. Okay. And down here again. But here, for the first time, now when prices are basing here after all this, you're probably going to think, you know what, we're just going to drop again. But the key thing here is don't think. Okay? Don't think. Yeah, if there's no congestion for being, you're going to get no congestion on the arrival, almost always. But so here, instead of getting another decline, we get our first rally with this green bar. That tells us objectively that we've now reached price levels in this market, whatever market it is, where demand exceeds supply. Therefore, we want to buy the first pullback into this area. Okay? This is how we caught the 2009 low in the stock markets. This is how we caught the high this year, I believe, on March 3rd. Is that March or April 3rd? March 3rd or April 3rd? I have to look, but we had it all in our we have it on slides in our things. It's because you get your first big move away, and we just natural gas on the bottom. You just had your first explosive move up instead of another drop out of a base. We were able to get in on the first pullback. Okay, same thing. So we want to get in here before the obvious conventional trend is underway. By the time you get a series of higher highs and higher lows, again, the trade, it's so far after the fact. Your risk is enormous. Your reward is tiny. Anyway, I think you get the point. Okay. One other thing here I want to go over before we get to the live charts. Okay. Yeah, Brad, it's funny because when natural gas was trading in the 20s, I heard people saying it was going to 50. And as soon as that happened, then it almost became free, right? So it's funny. That's like what did someone say? Apple to 1,000. That was about it there. But you look at the supply levels on Apple on the 60-minute chart. I could put them in a manual. They're perfect, right? Okay. So take a look here. There's one other way that people conventionally, in conventional terms, quantify trends, and I want to go over this just so you can be careful. All right. Again, I have no ties to any brokerage firm or anything. My only goal is that you understand this and you're successful. So take a look, and it has to do with moving averages. All right. Notice here we have two. Here's a cluster of trading and a strong rally out of that level. Another base, strong rally. Two demand levels that would score out fairly high when you look at the OTA odds enhancers that we go over. But take a look. When price comes back into this level, the 20-period moving average, just like just about any other moving average, is sloping down. And most people think, well, you never buy into a market when a moving average is sloping down. Well, guess what? Every single one of our trades that we take, longs and shorts, right? Every time we buy into a market, the almost all moving averages are going to be pointing down. Okay. Almost every time, I will say, every time we sell into a market, sell short, right? If you remember some of those Euro trades we've had recently, all the moving averages are pointing up. They have to be. Remember, how you make money buying and selling in markets when you trade, short-term or long-term, is exactly how you make money buying and selling anything else. Okay. Over here, not only is, when price comes into our key demand level where we want to buy right here with our stop just below, okay. Yeah, good point there, FX. Absolutely. They're great when they're in the right place. And again, that all has to do with the odds enhancers. So when we're ready to buy right here, not only is the 20-period moving average sloping down, price is below the 200 moving average. And if this market is the Euro or the S&P, what are they going to be saying all day long on TV? They're going to, be like news alerts, breaking news. Do not buy into the S&P because it's now below the 200-day moving average. Well, what if you walked in your favorite store, and there was a sign right there that said your favorite item that you came to buy that day was on sale for half price, and there's only 5 left, and they're in the back of the store. Are you going to leave and because not a good idea to buy them? No, you're going to run and buy as many as you can. You see what I'm saying? It's the same thing. Okay. No, we are just buying strictly off of price. What the candle picture or pattern is irrelevant. Okay, that's just a function of time frame. Okay, and I don't even know what moving averages are. It doesn't even matter. Simple exponential. I don't use moving averages. I've never used them because all they are is an average of prior prices, which does me no good as a trader. They don't know where the banks and institutions are buying and selling. So I don't want to spend time with them.